Part 1 of BTC History. The Mystery. Who is Satoshi? The global financial system is collapsing. Lehman Brothers, bankrupt. Bear Stearns, gone. AIG, bailed out. Millions lose their homes, their savings, their futures. Banks that were too big to fail, failed anyway. Governments gave them trillions in taxpayer money to survive. Trust in the financial system shattered. October 31st, 2008, Halloween. While the world burned, someone posted a 9-page document to an obscure cryptography mailing list. The subject line, Bitcoin, a peer-to-peer electronic cash system. The author, Satoshi Nakamoto. Nobody knew who Satoshi was. Nobody knew if it was one person or a group. Nobody knew if it was even a real name. But the idea was revolutionary. Money that didn't need banks. Money that didn't need governments. Money that couldn't be printed, inflated, or controlled by anyone. Digital cash that worked like physical cash, peer-to-peer, no middleman. This is the story of how a mystery person created a $2 trillion revolution, a story of pizza that cost $800 million, of hackers, crashes, and comebacks, of countries adopting Bitcoin as legal money. This is the complete history of Bitcoin, and it starts with one question. Who is Satoshi Nakamoto? To understand why Bitcoin exists, you have to understand 2008. For decades, the world trusted a simple system. Governments control money, central banks print it, commercial banks lend it. But in 2008, that system revealed its fragility. Banks had created complex financial instruments, derivatives, mortgage-backed securities, credit default swaps. They gambled with money they didn't have, assuming housing prices would rise forever. They were wrong. When the housing bubble burst, the entire global financial system seized up. Banks stopped lending. Businesses couldn't get credit. People lost jobs. Foreclosures skyrocketed. And then came the bailouts. The same institutions that caused the crisis were rescued with taxpayer money. Too big to fail became the justification for privatizing profits and socializing losses. Occupy Wall Street protesters chanted, "Banks got bailed out, we got sold out." Meanwhile, in corners of the internet, cryptographers and programmers asked a different question. What if we didn't need banks at all? October 31st, 2008. The Bitcoin Whitepaper appeared. 9 pages. Technical but readable. Revolutionary but practical. The problem Satoshi identified was simple. Digital money had always required a trusted third party, a bank, to prevent people from spending the same money twice. If I send you a digital file, I still have the original. That's fine for photos. It's catastrophic for money. Banks solved this by keeping a central ledger. They tracked who owned what. They verified every transaction. But that gave banks enormous power. They could freeze accounts. They could deny transactions. They could inflate the money supply. Satoshi's solution was elegant. Instead of one central ledger controlled by a bank, create a distributed ledger maintained by thousands of computers around the world. Every transaction gets recorded in a block. Every block is linked to the previous block, forming a chain, hence blockchain. To add a block, computers compete to solve complex mathematical puzzles. The winner gets to add the block and receives newly created bitcoins as a reward. This is called mining. The network is designed so that creating a fake transaction would require controlling 51% of the computing power, practically impossible as the network grows. No central authority, no single point of failure, no one to trust but mathematics. The cryptography community was intrigued but skeptical. Digital currencies had been tried before. DigiCash, eGold, BitGold, all had failed. What made Satoshi think this would work? January 3rd, 2009, 6:15 p.m. GMT. Satoshi Nakamoto mined the first Bitcoin block, the Genesis block. Embedded in the code was a message, a timestamp. The Times, 03 Jan 2009 Chancellor on brink of second bailout for banks. It was a headline from that day's London Times. A reference to the ongoing financial crisis. A statement of purpose. Bitcoin was born from the ashes of financial collapse. A protest against central banking. A declaration of independence from government money. For months, Bitcoin was just Satoshi and a handful of cryptography enthusiasts running nodes on their computers. The software was buggy. The network was tiny. Each Bitcoin was worth nothing. But slowly, people started paying attention. Hal Finney, a legendary cryptographer, was the first person besides Satoshi to run the Bitcoin software. On January 12th, 2009, Satoshi sent him 10 Bitcoins, the first Bitcoin transaction between two people. Others joined. Programmers fixed bugs. Miners contributed computing power. By late 2009, Bitcoin had value for the first time. Not much, fractions of a cent, but value nonetheless. People were trading it, experimenting with it, believing in it. The revolution had begun. For 2 years, Satoshi guided Bitcoin's development. Satoshi posted on forums, fixed code, answered questions, worked with early developers like Gavin Anderson and Hal Finney. But Satoshi remained anonymous. No photos, no personal details. Perfect operational security. Then, in April 2011, Satoshi sent a final email to Gavin Anderson. "I've moved on to other things. The future of Bitcoin is in good hands," and vanished. Who is Satoshi Nakamoto? Theories exploded. Was it a single genius programmer, a team of cryptographers, a government agency? Suspects emerged. Hal Finney, the first recipient of Bitcoin, brilliant cryptographer. He denied it until his death in 2014. Nick Szabo, creator of BitGold, a Bitcoin predecessor, he denied it. Dorian Nakamoto, California man whose birth name was actually Satoshi Nakamoto. Journalists hounded him. He denied involvement. Craig Wright, an Australian programmer who claimed to be Satoshi, he couldn't prove it. Courts have ruled against him. Here's what we know. Satoshi mined approximately 1 million Bitcoins in the early days. Today, that's worth over $100 billion. Those coins have never moved. They sit in wallets, untouched, like digital treasure buried by a ghost. Either Satoshi has superhuman discipline not to spend $100 billion, or Satoshi is dead, or those private keys are lost forever. Satoshi Nakamoto created a $2 trillion revolution and disappeared without spending a single dollar of personal profit. It's the greatest mystery in tech history, and it might never be solved. But the creation didn't need its creator anymore. Bitcoin had taken on a life of its own. Part 2, From Pizza to Peak. May 18th, 2010. Bitcoin Talk Forum. A programmer named Laszlo Hanyecz posted a simple request: "I'll pay 10,000 Bitcoins for a couple of pizzas." At the time, 10,000 Bitcoins was worth about $41. Nobody had ever used Bitcoin to buy something in the real world. It was a digital experiment, worthless outside the small community that believed in it. But Laszlo wanted to prove Bitcoin could work as actual money. May 22nd, 2010. Someone accepted the offer. A volunteer in England ordered 2 Papa John's pizzas delivered to Laszlo's house in Florida. Laszlo sent 10,000 Bitcoins. The first real-world Bitcoin transaction was complete. Today, those 10,000 Bitcoins are worth over $1 billion. Laszlo Hanyecz bought the most expensive pizza in human history. In interviews years later, Laszlo said he doesn't regret it. He was part of history. He proved Bitcoin worked. But May 22nd is now celebrated as Bitcoin Pizza Day, a reminder of how far Bitcoin has come, from $41 to billions, from a curiosity to a revolution. But Bitcoin's early growth had a dark side. February 2011, a website launched on the dark web called Silk Road. It was an Amazon for illegal drugs, heroin, cocaine, LSD, anything you wanted delivered to your door, and it only accepted Bitcoin. The creator, Ross Ulbricht, used the alias Dread Pirate Roberts. He believed in radical libertarian freedom, the idea that people should be able to buy and sell anything without government interference. Silk Road was his experiment, and Bitcoin was the perfect currency for it. Anonymous, untraceable, or so they thought, no banks to freeze accounts. For 2 years, Silk Road thrived. Millions in transactions, thousands of users, but it gave Bitcoin a terrible reputation. Politicians called it criminal money. Media portrayed Bitcoin as a tool for drug dealers and terrorists. October 2013, the FBI shut down Silk Road. Ross Ulbricht was arrested in a San Francisco library. He was convicted and sentenced to life in prison without parole. When Silk Road fell, many expected Bitcoin to die with it. Instead, something surprising happened. Bitcoin's price barely moved. Because by 2013, Bitcoin was bigger than Silk Road. Legitimate businesses were accepting it. Investors were buying it. The technology had proven itself. Silk Road was Bitcoin's dark chapter, but it wasn't Bitcoin's story. By 2014, if you wanted to buy Bitcoin, you probably used Mt. Gox. Mt. Gox was a Bitcoin exchange based in Tokyo, run by a Frenchman named Mark Karpeles. At its peak, it handled 70% of all Bitcoin transactions worldwide. If you trusted your Bitcoin to Mt. Gox, you trusted Mark Karpeles. February 2014, Mt. Gox suddenly stopped processing withdrawals. Users panicked. Where was their money? February 28th, Mark Karpeles held a press conference. The answer was devastating. 850,000 Bitcoins, worth $450 million at the time, were gone. Hacked, stolen, lost. Nobody knew exactly what happened. The Bitcoin community was shattered. People lost life savings. The price crashed. Media declared Bitcoin dead. Mark Karpeles became the most hated man in crypto. He was arrested, spent time in jail, and was eventually acquitted of most charges. Some Bitcoins were recovered, but most are still missing. Mt. Gox proved a crucial lesson. Not your keys, not your coins. If you don't control the private keys to your Bitcoin, you don't really own it. Trusting exchanges is trusting a third party, exactly what Bitcoin was designed to eliminate. But again, Bitcoin survived. The network kept running. New exchanges emerged. Developers improved security. By 2015, Bitcoin was recovering. And then came 2017, the year everything changed. January 2017, Bitcoin was $1,000. December 2017, Bitcoin was $20,000, a 2,000% increase in 1 year. The world went insane. Your Uber driver was talking about Bitcoin. Your grandmother was asking about Bitcoin. CNBC ran Bitcoin tickers 24/7. Everyone thought they'd get rich. What caused it? Multiple factors. Japan recognized Bitcoin as legal tender. Institutional interest grew. Futures markets launched. But mostly, it was FOMO, fear of missing out. People saw Bitcoin doubling, tripling in price. They bought in. The price went higher. More people bought. A classic bubble. Bitcoin will hit 100,000 stars. Bitcoin will replace all money. Bitcoin is the future. The hype was deafening. And then, December 17th, 2017, Bitcoin peaked at $19,183 and the bubble popped. Part 3, Crash and Comeback. By December 2018, Bitcoin had crashed to $3,200, an 85% drop from the peak. People who bought at $20,000 lost everything. I told you so, said the skeptics. Bitcoin is dead, said the media, for the 100th time. This was crypto winter, a brutal, soul-crushing bear market. Projects failed, exchanges collapsed, scams were exposed. ICOs, initial coin offerings, that had raised billions were revealed as worthless. Thousands of people lost their life savings. Suicide hotlines were posted on crypto forums. But something interesting happened during crypto winter. The true believers didn't leave. Developers kept building. The Bitcoin network kept running. Every 10 minutes, a new block was mined. But the code didn't care about the price. The protocol didn't care about human emotion. Bitcoin just continued. And quietly, institutions started paying attention, not retail investors chasing profits. Institutions. Fidelity launched a crypto division. Backed by the New York Stock Exchange, prepared Bitcoin futures. Yale's endowment invested in crypto funds. Wall Street was entering. Why? Because despite the crash, Bitcoin had proven something. It survived. It survived Mt. Gox. It survived Silk Road. It survived an 85% crash. The network had run for 10 years without a single hour of downtime. No government had shut it down. No hacker had broken it. That kind of resilience is rare. That kind of resilience is valuable. Then 2020 arrived, and everything changed again. March 2020, COVID-19 pandemic, global lockdowns, economic panic, stock markets crashed. Governments worldwide responded with unprecedented money printing, trillions in stimulus, trillions in quantitative easing. Central banks bought bonds, stocks, anything to keep the economy from collapsing. And people remembered why Bitcoin was created, as a hedge against inflation, as a protection against government money printing, as digital gold. Bitcoin's price started rising, slowly at first, then faster. By December 2020, Bitcoin was back at $20,000, the 2017 peak. But this time felt different. This wasn't retail FOMO. This was institutional adoption. PayPal announced users could buy Bitcoin. Square bought $50 million in Bitcoin for its corporate treasury. MicroStrategy, a publicly traded company, bought $425 million in Bitcoin. Their CEO, Michael Saylor, became Bitcoin's loudest evangelist, buying more and more. And then, February 2021, the announcement that changed everything. Tesla had bought $1.5 billion in Bitcoin. Elon Musk, the richest man in the world, had bet on Bitcoin. Tesla would accept Bitcoin for cars. Elon tweeted constantly about crypto. The market exploded. Bitcoin hit $30,000, then $40,000, then $50,000. In April 2021, Coinbase, the largest U.S. crypto exchange, went public, valued at $86 billion on its first day. Crypto was officially mainstream, but the real shock came from a small Central American country, El Salvador. In June 2021, President Nayib Bukele announced El Salvador would make Bitcoin legal tender. Not just legal to own, not just legal to trade, legal tender. You could pay taxes in Bitcoin, buy groceries in Bitcoin, receive your salary in Bitcoin. The Bitcoin community celebrated. A country had adopted Bitcoin. The IMF and World Bank condemned it. Economists predicted disaster. But El Salvador went ahead. September 7th, 2021, Bitcoin Day. Every Salvadoran received $30 in Bitcoin. ATMs were installed. Businesses were required to accept it. It was chaotic. The app crashed. The price dropped. Protests erupted. But El Salvador persisted. And other countries watched. Panama, Paraguay, and others considered similar moves. Bitcoin wasn't just an investment anymore. It was geopolitical. November 2021, Bitcoin peaked at $69,000, the all-time high. From $0 to $69,000 in 12 years. Early adopters who bought at $100 were now millionaires. The pizza guy's $10,000 Bitcoin would have been worth $690 million. But the euphoria didn't last. By December 2021, Bitcoin was falling. And then November 2022, FTX collapsed. FTX was the second largest crypto exchange in the world, run by Sam Bankman-Fried, a billionaire who hung out with celebrities and politicians. FTX seemed safe, regulated, trustworthy. It was all a lie. Sam had been using customer funds to gamble at his trading firm Alameda Research. Billions were missing. FTX filed for bankruptcy. Sam was arrested, extradited, tried, and convicted of fraud, sentenced to 25 years in prison. Another Mt. Gox, another betrayal. Bitcoin crashed to $15,000, crypto winter 2.0. The skeptics returned, "See, it's all a scam." Regulators cracked down. The SEC sued crypto companies. Banks refused to work with crypto firms. It felt like the end. But Bitcoin kept running. Every 10 minutes, a new block. The network didn't care about FTX. It didn't care about Sam Bankman-Fried. It just kept working. Because Bitcoin isn't run by a company. It isn't controlled by a person. It's a protocol. And protocols don't have emotions. Part 4, the revolution. Bitcoin now. Crypto winter continued. Prices stayed low. Projects died. But beneath the surface, something was building. BlackRock, the world's largest asset manager with $10 trillion under management, filed for a Bitcoin ETF, an exchange-traded fund that would let mainstream investors buy Bitcoin through their regular brokerage accounts. This was massive. BlackRock had never lost an ETF application. If approved, it would open Bitcoin to retirement accounts, pension funds, institutions that couldn't directly buy Bitcoin but could buy an ETF. Other firms followed. Fidelity, Invesco, WisdomTree, all filed. The race was on. Bitcoin's price started rising again, from $15,000 in late 2022 to $30,000 by mid-2023. Not because of hype, because of institutions. Then, October 2023, a false rumor spread that the Bitcoin ETF was approved. Bitcoin spiked to $30,000 in minutes. The rumor was fake, but the market's reaction showed how much demand was waiting. January 10th, 2024. The SEC approved 11 Bitcoin spot ETFs simultaneously. BlackRock's iShares Bitcoin Trust, Fidelity's Wise Origin Bitcoin Fund, Grayscale's Converted Trust, all approved. Bitcoin exploded. In the first week, the ETFs saw $10 billion in inflows. But it wasn't just price. Bitcoin was changing structurally. Countries beyond El Salvador were accumulating Bitcoin. Bhutan was mining Bitcoin with hydroelectric power. The Central African Republic briefly adopted it. Rumors swirled that others would follow. In the US, political attitudes shifted. Donald Trump, once a Bitcoin skeptic, embraced crypto during his 2024 campaign. He promised to make the US the crypto capital of the world. He accepted campaign donations in Bitcoin. He spoke at Bitcoin conferences. Other politicians followed. Pro-crypto candidates won elections. The anti-crypto Senator Elizabeth Warren's allies lost seats. The crypto industry had become a political force, spending millions on campaigns. Whether you loved it or hated it, Bitcoin couldn't be ignored. March 2024, Bitcoin hit a new all-time high, $73,000, this time before the halving. Bitcoin's code is programmed to cut mining rewards in half every 4 years. Historically, halvings preceded massive bull runs. The 2024 halving happened in April. If history repeated, the real bull run was still ahead. And it was. Throughout 2024, Bitcoin climbed. MicroStrategy kept buying. Michael Saylor's company now held over 400,000 Bitcoin, more than most countries. He called it digital property, the ultimate store of value. His bet was paying off spectacularly. November 2024, Donald Trump won the presidential election. Crypto markets exploded. December 2024, the moment everyone was waiting for. Bitcoin crossed $100,000 for the first time. From worthless to six figures, from pizza money to $1 trillion asset class, the journey was complete. Or was it just beginning? El Salvador's Bitcoin experiment showed mixed results. Tourism increased. Some businesses thrived. But adoption was slow. Most Salvadorans preferred dollars. The IMF demanded they scale back Bitcoin. The experiment continued, but success wasn't guaranteed. Other countries watched. Some, like China, banned Bitcoin mining and trading entirely, calling it a threat to financial stability. Others, like Switzerland and Singapore, embraced crypto with clear regulations. The world was splitting, crypto-friendly and crypto-hostile. Meanwhile, Bitcoin's energy consumption remained controversial. Mining requires massive computing power. Critics said it was an environmental disaster. Proponents countered that 50% of mining used renewable energy, more than most industries. El Salvador mined with volcanoes. Texas used excess wind and solar power. The debate raged on. But the fundamental question remained, what is Bitcoin's purpose? A currency? Gold 2.0? A speculative asset? A revolutionary technology? Even Bitcoin supporters disagreed. Some believed Bitcoin would replace government money. Hyper-Bitcoinization, a world where Bitcoin becomes the global reserve currency. Others saw it as digital gold, a store of value that coexists with dollars and euros. Others admitted they had no idea but believed the technology mattered. What's certain, Bitcoin changed finance forever. It proved cryptocurrency could work. It inspired thousands of other projects. Ethereum, Solana, Cardano. It challenged central banks to create digital currencies. It made blockchain technology mainstream, and it created a new kind of wealth. Early adopters became millionaires by believing in an idea. Programmers who contributed code, miners who secured the network, people who held through crashes and ridicule. They were rewarded not by a company or a government, but by mathematics and belief. But it also created victims, people who bought at peaks and sold at bottoms, people who trusted exchanges that failed, people who fell for scams, people who lost passwords to fortunes. Bitcoin's history is triumph and tragedy. 15 years after the Genesis block, Bitcoin is simultaneously a $2 trillion asset. Legal tender in one country, banned in others, loved by libertarians, feared by governments, called the future by some, a scam by others. And despite everything, the crashes, the hacks, the bans, the scandals, it's still here, still running, still mining, still sending transactions every 10 minutes, forever. As long as one computer runs the software, Bitcoin exists. Satoshi created something that can't be killed, can't be shut down, can't be controlled. Whether that's brilliant or dangerous depends on who you ask. But here's what's undeniable. Bitcoin changed the conversation about money. It forced us to ask, who should control it? Why do we trust banks? What gives money value? Can we build systems that don't require trust? These questions won't go away. Whether Bitcoin succeeds or fails, it started a revolution. And revolutions don't end cleanly. They ripple through history, changing things in ways we can't predict. So what happens next? Bitcoin at 200,000? 1 million, or crashes to zero, more countries adopt it, or governments crush it? Does Satoshi ever reveal themselves? Do we solve the mystery? Nobody knows. That's the point. Bitcoin is an experiment. We're all watching it unfold in real time. Some of us are participating, some are betting against it, but we're all witnesses to history. Because 15 years ago, someone posted a 9-page paper, and the world changed. I'm Name, and this is the History Creator. The future is being written right now, and you're part of the story.